Welcome to Echo Trade. I'm Jeff Roth, your host. Today we are talking to Howard Hansen from LindeHansen and Company. Howard, how you doing? Appreciate you being here.
I'm doing well. Good to be here. Thank you.
Yeah, so today we're going to talk about compound interest. And so, people might look at compound interest as kind of a 101 type of a topic, but at the end of the day, in my view, as I think about it, as we're preparing for this, I'm realizing that it's probably the most important concept within investing as a whole. You can maybe forget or learn everything that you've ever known about investing, be a complete beginner. But if you understand the power of compound interest, then you can reap the benefits of, Einstein called it the eighth wonder of the world, right? So I think he also said that it's the most powerful force in the universe. So break it down for us, just starting high level. What is compound interest, and how has it, created massive amounts of wealth for people for hundreds of years?
Okay, yeah, it's a great topic. It's one that's really essential for all investors to understand. You need to understand compound interest. You need to understand exponential math, because they both are basically the same thing.
Yeah.
So if you were to think about it in investing terms, and you made an investment in something, you put $100 into it, and it pays a 10% interest rate over the course of a year. You put your $100 in. At the end of the year, you get $10. Next year, $100 is still there. You get another $10. So if I took my $10 that I earned in interest each year and just put it under the mattress, after 10 years, I'd have accumulated $100. My total investment value is $200, and I'm doing okay.
Mm-hmm.
On the other hand, though, if you took that extra $10 each year and reinvested it at the same rate, it can reap great benefits. So I put $100 in year one. At the end of year two, at the end of year one, I get my $10. I now have $110 invested. At the end of year two, I've got $11 of interest. I add that back in. I now have $121 invested, and I will receive $12.10 in year two. And that will keep continuing to compound over time. So that if we were to put that horse race of the first strategy versus the second, after 10 years, you'll find you have actually $259 as opposed to $200. The extra $59 came from the interest on your interest. And so compounding's always made sense to me as being able to earn interest on your interest. And if you keep doing that over time, it can be very powerful, and it can help to build wealth and create, a larger bank account.
Exactly. And that's all we're all looking for, right? And the idea basically, essentially, when you boil it down to, it's just you're accelerating growth. Your growth increases year after year after year. And so, to illustrate that concept, I think Buffett, even though, starting investing at 10, 11, 12 years old, whatever it was, he started early. I think the majority of his wealth, came after age 60 or something of that nature, or even more after 70, just because he had generated so much with that compound that it just compounded even faster. So you're just growing faster and faster as those investments compound each other, and the interest compounds on each other. So I think, with that, it leads me into the idea right now, and it's 2023, and last year there's a lot of market sentiment that there's fear in the market of waiting for the right time to enter the market, even having conversations with friends and family about this. And so, there's a fear of recession. There's a fear of the volatility that's going on. But compound interest would obviously kind of recommend that you don't listen to when's the best time to enter the market. It's just the earlier you enter, the better, probably. And it's the time in the market, correct?
That is correct. There are 1,000 sayings on Wall Street, and most of them actually make a lot of sense. One of them is the hardest time to invest is right now.
Yeah.
And it's always right now, because there's always something going on in the world. There's always a problem. There's always a recession on the horizon, and there's 1,000 reasons why you shouldn't do it. One of the other sayings is, it's not for an investor, the most important thing is time in the market as opposed to timing the market.
Yeah.
And that's an important, and it's a powerful thought, because it really does play into the whole idea of compounding. The longer that you have your money in the market, the greater the opportunity you have to be exposed to the positive compounding over time. If you're trying to time the market and move in and out, you'll make the common mistake that most people do. You sell low and buy high. And you don't want to be doing that, because the way compounding works is it's equally as penalizing on the downside as it is beneficial on the upside. So if I go down 20%, I have to go up 25% in order to break even. And people don't realize that. So when the market cracks, or there's a war in the Middle East or in the Ukraine, and they freak out and they sell, they're probably selling near a bottom. And then when they buy back in, they're buying at a higher point. If you have the confidence and the commitment to be a longer term investor, you can ride through some of those ebb and flows and not really be penalized. Because if you think about that compounding aspect, you're putting a tax on your portfolio if you sell in panic and buy back at a higher level.
Exactly.
You really don't want to do that. It makes your portfolio have to work harder than it would naturally. And so by staying invested and thinking about that time in the market as opposed to timing the market, it really does give you the opportunity to benefit over long periods of time of the natural state of the stock markets, which is generally to trend higher as companies make more money over time.
Yeah, exactly. I mean, if there's one thing that I could do going back to, my 18-year-old self, I mean, there's a lot of things that I would tell myself, but definitely one of them would be on how I was spending my money, and kind of be able to benefit more from this concept that we're talking about. So, I mean, talk about the broader implications, though, understanding kind of the basic concept of compound interest, but what are kind of some broader implications for investors?
Well, broader implications, obviously you need to understand exponential math. You need to understand that if I go down 20%, a 20% return isn't going to take me back to break even. I need to go up 25%. So I go from 100 to 80, I need to make $20 to get back to where I started. That's 25%.
Yep.
I think that the mistake, one mistake people make is they panic and they sell out when they're afraid. The other mistake investors make is they don't really understand the investments that they've made. They don't understand the business they're invested in. They don't understand the actual security that they bought, and it ends up being not to their benefit. The more that you kind of are committed to either a strategy, a particular company, a stock, a bond, if you understand it as much as you can, it gives you the ability to really take advantage of that compounding, not sell out when you get a panic, not make that mistake of selling low, buying high, and being able to keep your money fully invested over time in order to take advantage of that compound year after year after year. You mentioned Buffett.
Yeah, go ahead.
You mentioned Buffett earlier, and I won't pretend to be an expert on Buffett, but one of the things that he's always talked about, and the kinds of businesses that he's been wanting to buy for the last couple of decades, are companies with high returns on equity that have ample opportunity to reinvest. And so what does that mean? It means if I have a 20% return on equity, I pay out 5 percentage points as a dividend. I've got 15% to reinvest. I can keep reinvesting at that return on equity of 20%. If you have a company or business that earns a great return like that, if they can continuously redeploy cash into a high return on equity business, that is a growth machine. If you compound at 10%, you saw we earned extra money. If you compound at 20%, it's even better. So you're always looking for businesses that can kind of compound. You want to understand what it means for your portfolio and those individual stocks, but you also want to understand what it means for the businesses you're investing in. What opportunity do they have to compound the growth in their earnings, which will, by definition, end up benefiting your portfolio?
Yeah, and you talked about one thing really quickly, in terms of, see the whole concept of timing the market versus timing the market. And to Buffett's point, he wants to buy companies. The best time to sell is never. But obviously, you guys are actively managing a portfolio that's offered within Echo Trading, the contrarian value portfolio, and for your clients. So what are the things that you guys look at to actually determine when it is time to exit a position?
Generally for us, the time to exit a position is when your reasons for owning it are no longer valid. So you buy a company based on a certain set of criteria. You're looking for them to execute against that criteria. If at some point in time you determine that, yeah, it's not going to work, that our thesis may have been wrong, market conditions have changed, something has changed in the interim, you should sell that stock really regardless of the price.
And I think what's important, yeah, and what's important there, I would imagine, is you guys have a strategy that's going along with that. You know what you're looking for. You know the reasons you got in, and you know what would turn those around in order to get out. Because the point that you're making is people they're making these types of a decision with a massive amount of information coming in from talking heads, and then, oh, I hear a recession's coming. Oh, they may raise interest rates again, and that's going to cause X, Y, and Z. And inflation is still high. It's higher for longer, pulling them out of the market over an emotional response versus a strategic and informed response based off of what you had thought about as you entered the position. You knew what it would take to actually get you out of the position.
Correct. And so it's as you mentioned a little earlier, that you never really want to have to sell. You want to buy that company that continuously compound its earnings and continue to grow its earnings. That said, there are times where things get crazy and valuations get overdone, or stocks go up for reasons that you're not anticipating. Those are valid opportunities to either trim the position or to sell it outright. The same is true in the reverse. One company we own right now is Zimmer Biomet. They make replacements for knees and hips. You may have heard about that weight loss drug that's being pushed, and it's very popular right now, getting a lot of press. It's led people to believe that the entire nation is going to become fit and trim overnight. It's not going to happen. So, if you look at that kind of a circumstance, if people are actually selling a stock for those particular reasons, that's an opportunity to buy something that has traded down. So if it's in your portfolio already, the stock is traded down, that could be a good opportunity to step up and add to the position. Whereas if you have a company and it was easier to find examples back during the meme days, but it becomes a meme stock and it goes to a valuation which is absolutely insane relative to your expectations for the business. That's a good opportunity to trim back too. But I think what's common to both of those thoughts is you really need to know and understand why you own that business, what you're looking for from it, and have a set of parameters from valuation as well as from an earnings and a return on capital, return on investment that business can earn in order to make an educated decision on when to buy more or when to sell it all.
Yeah, it's really funny that you bring up the weight loss drugs. I literally had a conversation last week with one of our partners, and they had the same response that some of the hype around these drugs has maybe artificially lowered valuations and prices on some other companies that have negatively affected by those responses. And he actually texted me a day or two later after the conversation that one of their holdings went up 5% that day. And again, we're not worried too much about daily fluctuations as more of a long-term portfolio, but still it was a funny anecdote right there, and that you kind of brought up the same thing. But no, I mean, to your point, the concept around here is that have a defined strategy when you're looking to actually make any changes to the portfolio. But at the end of the day, time in the market is more important than timing the market, and you're going to take advantage of again what Einstein called the most powerful force in the universe, which is compound interest, and it's all going to have that force to fatten our bank accounts, which is what we're here for. So Howard, I appreciate the time. Thanks for being here. Thanks for the insight.
Thank you, Jeff.
And investors, you can check out Howard's portfolio, the LindeHansen Contrarian Value portfolio on EchoTrade.